If you've been trying to follow the housing market or just, the economy in general, mortgage rates seem like they're always doing something different, up, down. It's a lot.
It really is. And figuring out those shifts is, well, it's pretty crucial. It hits your wallet directly if you're thinking about buying or refinancing.
Exactly. So today we're doing a deep dive into one specific source, an article that came out June 5th, 2025, but it looks back at what happened with mortgage rates on June 4th. Just one day, but we're using this article's data to unpack it.
Right. And the plan isn't just to read out the numbers for June 4th. We want to see how that day fits into the bigger picture the article paints, the historical context.
And crucially, pull out the reasons this source gives for why rates move the way they do.
Yeah, what makes them so volatile? Trying to understand the why behind the numbers.
Okay, let's jump in then. What was the big headline from this article about June 4th? What actually happened?
The main takeaway from the source was that rates for new 30-year fixed mortgages, they actually dropped on June 4th. A noticeable dip.
A drop. Okay. Did the article give a specific number for the average rate that day?
It did. It cited the average 30-year fixed, based on the Zillow Mortgage API data, landing at 6.97%.
6.97%. And how significant was that particular level, according to the article, in the immediate sense?
Well, the source pointed out that 6.97% was actually the lowest average they'd reported for that main 30-year rate since early May.
So almost a 4-week low then.
Exactly. According to their data, yeah. A bit of a breather after being higher.
Interesting. And was it just the 30-year fixed, or did other loan types move too?
No, the article mentioned falls across other types as well. For example, the 15-year fixed rate, it sank 8 basis points.
Okay, hang on, basis points. Let's quickly clarify that.
Oh, good point. Yeah, a basis point is just tiny. It's 1/100th of a percentage point. So at 8 basis points down means the rate fell by 0.08%.
Right, 0.08%. Seems small, but over 15 or 30 years.
It adds up, absolutely. And the source also said the jumbo 30-year rate saw a similar move, down 8 basis points as well, ending at 6.95%.
Okay, so the snapshot for June 4th, based on this source, is a slight easing across the board. Key 30-year at 6.97%, lowest in nearly a month, and others like the 15-year and jumbo dipping too.
That's the picture for that specific day, yeah. A moment of rates pulling back a bit.
All right, so that's the what for June 4th. But 6.97%, I mean, is that high? Low. We need context. The article provided some historical comparisons, right?
It did, and this is where you really see the scale of things. The article contrasts that 6.97% with the one-year high it had recorded, that was 7.15%, reached just a couple of weeks before, in mid-May.
Ah, okay, so the June 4th drop was coming off a fairly recent peak then.
Exactly. But the article also throws in a reminder of just how much things have swung the other way, too.
You mean lower rates?
Much lower. It specifically mentioned that big plunge rates took last fall. According to this source, the 30-year average sank to a 2-year low of 5.89%.
Wow, 5.89, compared to nearly 7%. That's a huge difference, over a full percentage point.
It really is. That's a massive impact on a monthly payment. It highlights the kind of swings we've seen.
And did it look back even further? Like, what was the absolute peak recently?
Yes, the article mentioned the peak during this recent cycle of rate increases. It puts the current 6.97% well below the historic 23-year peak, which it clocked at 8.01% back in late 2023.
8.01%. Okay, so just using the 30-year fixed data from this article, we saw a peak over 8% in late 23, then a low under 6% last fall, a recent bump back over 7% in May, and now this June 4th reading just under 7%. That's quite a roller coaster.
It really captures the volatility the market has experienced over the last couple of years based on the source's tracking.
And does it give similar context for the other rates, like the 15-year? It was 5.96% on June 4th, you said.
Yeah, 5.96%. The article notes it's quite a bit cheaper than where it was in mid-April, which was 6.31%.
Yeah.
And compared to its own peak, it says that 5.96% is more than a full percentage point below the October 2023 peak of 7.08%. And the article calls that the 23-year high for the 15-year rate.
And just like the 30-year, it also hit a much lower point more recently.
Exactly. The source shows the 15-year touching 4.97% last September. That was its 2-year low. Again, part of that significant drop-off last fall.
Okay, and the jumbo 30-year, it was 6.95% on June 4th.
Right. The article provides context there, too. It mentions the jumbo rate had actually been higher, 7.16%, just the week before a 10-month high for that specific loan type.
So it also came down from a recent high.
Yes. And its low point last fall, according to the source, was 6.24%, which was its cheapest in 19 months. And its estimated peak, going back to October 2023 like the others, was around 8.14%.
So it really doesn't matter which loan type the article looked at. The story seems consistent. Huge swings over the past couple of years. Very high peaks in late 2023, a sharp dive last fall, and then rates kind of churning in this higher range more recently, with June 4th just being a slight dip within that range.
That's the historical narrative the article lays out. It also adds a really important note, though.
Ooh.
That these are average rates. They're based on, certain assumptions the data providers use, things like a 20% down payment, a credit score, and a specific range. The article mentions 680 to 739 for the Zillow averages.
Meaning my rate or your rate might be different.
Exactly. Your personal rate depends entirely on your own financial situation, your credit score, how much you put down, the lender, all sorts of things. These averages are just a benchmark, a guidepost. They won't match those super low teaser rates sometimes advertised either.
That's a really crucial piece of context. Thanks. Okay, so we've got the what for June 4th and the where it fits historically according to this source. Now the big one, why? Why do these rates jump around so much? What factors does the article point to?
The source describes it as a complex interaction of different market forces. It's not just one thing.
Makes sense. What are the main drivers it calls out?
It highlights three key influences. First, what's happening in the bond market specifically, the yield on 10-year Treasury bonds. Mortgage rates tend to sort of follow those movements.
Okay, bond yields. What else?
Second, the monetary policy decisions coming from the Federal Reserve, what they're doing with buying or selling bonds and where they set their target short-term interest rates.
The Fed, always a big player. And the third?
Just good old-fashioned competition. Competition between mortgage lenders trying to win business and also competition across different types of loans.
So bonds, the Fed, and lender competition.
Yeah.
All mixing together.
Exactly. The article emphasizes it's hard to pin down the exact impact of each one on any single day, but it does spend quite a bit of time explaining the Fed's role, especially in those big historical swings we talked about.
Okay, so how does the source explain the Fed's influence here? What's the story, according to the article?
It traces it back to the pandemic era. The article notes the Fed was buying up huge amounts of bonds, including mortgage-backed securities. This, it says, helped keep mortgage rates relatively low through much of, say, 2021.
Right, they're actively pushing down borrowing costs.
Pretty much. But then, the article says, things shifted. Starting in November 2021, the Fed began to taper those purchases, basically, buy fewer bonds. And by March 2022, they stopped net new purchases altogether.
They took their foot off that particular gas pedal.
Right. And then almost immediately, they started hitting the brakes. Hard.
To fight inflation.
Precisely. The article recounts how between March 2022 and July 2023, the Fed executed this series of very aggressive increases to the federal funds rate.
Which importantly isn't the mortgage rate itself, right?
Correct. And the article is clear on that. The Fed funds rate is that overnight rate for banks. It doesn't directly set mortgage rates. However, there's a big but. The source argues that the speed and the size of those Fed hikes, a massive 5.25 percentage points in just 16 months, had this huge indirect upward pressure on mortgage rates. It just made borrowing more expensive across the entire financial system.
So even though the link isn't one-to-one, the sheer force of the Fed's action definitely rippled through and pushed mortgage rates way up during that period.
That's the connection the article draws. It amplified the upward move significantly.
Okay, so that explains the big run-up. What happened after they stopped hiking in July 2023?
According to the article, the Fed then held that federal funds rate steady at that high level for almost 14 months.
Just parked it there.
Yeah, holding steady at the peak. Until last fall. The source mentions the central bank then announced a rate cut in September, a half percentage point cut followed by smaller quarter-point cuts in November and December.
Okay, so some easing started towards the end of last year. What about this year, 2025, based on the article?
The article reports that the Fed had its third meeting of 2025 back in March, and at that meeting, they decided to hold rates steady again. No change.
Another hold. And did the article mention anything about expectations for the rest of the year?
It did. And this is pretty significant. It referenced the Fed's own forecast that they released at that same March 19th meeting. At that point, the median expectation among the Fed officials themselves was for only 2 more quarter-point rate cuts for the entire rest of 2025.
Wow. Only 2 more cuts anticipated by the Fed itself as of March.
That was the median projection, yes. And the article points out, there were still 5 scheduled rate-setting meetings left in the year after March.
So if they only expected 2 cuts across 5 meetings,
It implies they might have been anticipating several more announcements where they just hold rates steady again.
that paints a picture, based on the source's reporting of the Fed's own forecast for March, of a pretty cautious path ahead. Limited easing expected.
Exactly. It suggests a shift from the aggressive hikes to a long hold and now maybe just very gradual, limited cuts. And that context helps explain why, even with dips like the one on June 4th, rates haven't just collapsed back to those super low levels, according to the factors laid out in the article.
That makes sense. Okay, one last thing the article touched on that seems helpful for listeners. It mentioned the difference between the daily average it uses from Zillow and another common benchmark, the Freddie Mac weekly average. Can you break that down?
Sure. The source explains that Freddie Mac, which is obviously a huge player in the mortgage world, puts out an average rate, but they do it weekly. It mentions, for instance, that the Freddie Mac average for the week prior was 6.89%.
Okay, 6.89% weekly from Freddie Mac versus the 6.97% daily for June 4th that this article focused on. Why aren't they the same?
Well, the main reason the article gives is the timing.
Yeah.
That Freddie Mac number is an average calculated over a whole week. It blends 5 days of rate data together.
Ah, smoothing out the daily bumps.
Right. Whereas the Investopedia average, using that Zillow data, is a daily reading. The article suggests this daily snapshot gives you a more precise, more timely look at exactly where rates were on a specific day compared to the weekly blend.
So one's a snapshot, one's more like a rolling average for the week.
That's a good way to put it. The article also adds that small differences in how they calculate the average, like maybe slightly different assumptions about credit scores or down payments, or whether they include discount points, can also lead to small variations between different published averages.
That's really useful to know if you see slightly different numbers floating around. It's not necessarily the one is wrong,
Yeah.
just different methods.
Exactly. This article was just explaining its own daily metric and how it compares to that common weekly one.
Got it. Okay, so let's try and wrap this up. Based on this deep dive into the article from June 5th, looking back at June 4th, what's the main takeaway for someone trying to make sense of today's mortgage rate environment?
I think the core insight is this. Yes, rates like the 30-year fix did dip slightly on June 4th, hitting 6.97%, which this source called a near 4-week low. But that single day is just a tiny moment in a much, much bigger story of incredible volatility.
Right, we saw those huge swings in the historical data.
Exactly. From peaks over 8% down to lows below 6% just in the last couple of years. And this article really attributes that roller coaster ride mainly to those big macro forces. The bond market, and especially the Federal Reserve's actions, the past rapid hikes, the long pause, and now, based on that March forecast it cited, maybe a cautious outlook with limited cuts expected for the rest of 2025.
It definitely underscores that mortgage rates aren't just about housing supply and demand. They're tied into these massive economic currents.
And hopefully seeing how one day's number fits into that dramatic history and understanding the underlying reasons the source provides, that helps give you a clearer picture.
Definitely. So maybe here's something to think about. Building on everything this article laid out, we've seen this incredible volatility rates peaking above 8%, plunging near 5.8%. Now, this source highlights a Fed forecast from March, suggesting only 2 more quarter-point cuts might be coming for the rest of this year. How does that combination, the memory of wild swings plus this outlook for potentially limited future easing, how does that shape how you might think about where rates could possibly go from here? Something to mull over.